The other hot topic, which was the big hot topic at the ETF conference recently, and that's bond alternatives and maybe low volatility equities. That's a hot space. You've seen significant inflows into some big bond ETFs. Your ultra short income ETF, the symbol is JPST. That's had big inflows recently, as is everybody else. What is that, and why is that? Why are people flocking to that as a bond alternative? JPST is the symbol.
Here's the challenge, Bob. Investors know that the Fed has indicated that they're going to raise rates. In a rising rate environment, that's going to hurt your bond investments because of the old teeter-totter, right? So investors are looking for alternative ways to get that income into their portfolio. And so JPST is a great example. It's an ultra-short ETF with a duration of less than a year. Investors are really using that as a risk-off, a step out of cash within their portfolio, but still achieving some yield. It's now north of 1%, which we haven't seen yields like that in a long time, right? Remember, it wasn't too long ago there was $17 trillion in bonds with negative yields, and now we've only got about $3 trillion with negative yields. So we're seeing that. The other thing we're talking about now is, and we talked about it with commodities, outsized flows into the commodity space, also outsized flows into the covered call space. So we've got an ETF, JEPI. This is an equity portfolio, but using covered calls, some options, we can generate income above and beyond that. Because even though we have inflation...
And this JEPI intrigues me because this is the low volatility story, right?
Correct.
So that's been a big winner this year. Stocks that have lower volatility doing better, generally, you know, a lot of consumer names, for example. You've also seen significant inflows into that JEPI you mentioned. That's the equity premium income
so
ETF. This seeks to provide similar returns to the S&P 500 with lower volatility, and you get a monthly income, right? So you're selling calls here, right? Now, how does this work? This gets my head spinning. Trying to explain to people. It's essentially you're getting a little extra income because you're selling calls.
It's pretty straightforward, and this is a strategy that's been around for decades, right? So a basket of equities and then writing covered calls on those equities. So the S&P is down 13% year to date. JEPI, our covered call strategy, is only down 5%. So there's your low volatility story. But at the same time, we're targeting a 6 to 9% distributable yield because of that extra premium that's coming through on those covered calls. But we've actually been able to achieve quite a bit higher than that, given the volatility that's coming through the markets these days. And so that premium is a little bit higher. We've been able to achieve in some instances above 10%.
So the objective here is same return as the S&P 500 index with lower volatility combined with monthly income, essentially. That's what you're doing.
Yeah. I don't want this to sound too perfect. I mean, you are giving up some of the upside when you're getting those options, right? But the idea is you can have some protection to the downside. You're not going to take all of that downside capture as shown year to date, with the S&P being down 13, us only down 5. But then it also is going to get you that distributable yield. And remember, you're not taking on the duration. Importantly, you're not taking on the duration. You can still get that income, but you're not taking on the risk of duration in a rising rate environment.